Hi, everyone. Welcome to our webinar for today, Know Your Numbers. My name is James Lim, and I'm a business development and sales coordinator here at Brew Accounting, and I'll be your moderator for today. I'd like to introduce to you our today's presenter. Joanna Stewart is the director of Brew Accounting. Joanna has a passion for supporting small business to achieve mind freedom, time freedom, and financial freedom. She has worked across the globe leading large and small finance functions to deliver strategic business goals. She founded Brew Accounting 10 years ago and has gathered an excellent team of professionals together to support you and your small business to grow and prosper. Now, without further ado, let's all welcome Joanna Stewart. Take it away.
Thanks, James. And thanks, everyone, for taking the time to listen in to the webinar. We know time is important to each one of you, so we want to make this as meaningful as possible. They say numbers sometimes can be a bit boring, but at least it tells you the truth. Here at Brew Accounting, we are more than just your typical numbers people, as we are a team dedicated to helping people achieve more whilst having fun doing it. Thus, this free webinar to educate others so feel free to connect and share with others what we are doing. Before I start, I thought I'd share a thought for the session. The budget is not just a collection of numbers, but an expression of our values and aspirations. People have different opinions about numbers. Some people say they are boring. We are interested to hear your thoughts in the chat section. Also, please share what values and aspirations does your budget say about you and your business. I know certainly at Brew Accounting, our budget has an area where we want to give back to our community, and certain clients that we help, they're not profitable for us, but we feel that we align with their values and therefore we want to offer them our services. So yeah, please do share with us in the chat what your budget says about your business. Hopefully, you've all updated your budgets and forecasts to reflect the challenges of the COVID-19 situation. These numbers express your aspirations for the business over the next 12 months. Now it's time to make sure you can understand, monitor, and measure what you've set in those budgets and forecasts. This webinar is about demystifying the most common reports you'll be seeing on a weekly, monthly, quarterly, and annual basis, so that you're in control of your business performance. Before I go any further, what I will share with you is that I love numbers. I'm not one of those that think numbers are boring. And these are the types of reports that we look at every day. So if at any point I'm going too fast or you have a question, please do put it into the question panel, because if you're thinking it, the majority of the other people on this webinar are also thinking it. I certainly will try to give you a slow explanation of each thing, but yeah, there may be things that you don't understand, and please do ask. So one experience I'll share with you was something that I learned firsthand, this slogan, what we're seeing on the screen, very early in my career. One of my first jobs was working at Enron in London. For the 6 months that I worked there, the company was flying high and was the darling of the New York Stock Exchange. We were incentivized to buy Enron shares with their employee stock option scheme. I pumped all my savings, £10,000, which to me at the age of 23 was a lot of money, into Enron stocks. I thought these shares would make me rich, but alas, just 3 months later, Enron's world unraveled and I was left with nothing. Enron's corporate failure is emblazoned in the history books. It is a story of, if you don't know your numbers, then you don't know your business. As the liquidators and auditors descended, they discovered that the accountants, executives, and directors had actually committed significant fraud, much of it hidden in plain sight in the same reports that we're about to learn more about today. Knowing your numbers gives you control of your business, and especially as small business people, control gives you mind, time, and financial freedom as you learn which levers to pull and when to drive, so as to drive the best result for your business. Over the next 60 minutes, we'll cover the importance of knowing your numbers, an overview of the different reports you should be producing, the difference between profit and cash, the key drivers of business value, how to protect your assets, and how to adopt best practice. We'll then outline some potential next steps for you to take to make sure you truly understand your numbers. Plus, make sure you take plenty of notes today. Some of what we talk about might sound like a foreign language to you, what I like to call accountanese. So send through your questions at any time during the webinar for us to answer near the end. Knowing your numbers is vital as it allows you to interpret your reports and know if you're on track to achieve the goals set in your business plan or business recovery plan. Here are my top 6 reasons why you need to know your numbers. Number 1, they tell you the story of your business, allowing you to interpret the results of your business activity. And I'm not joking, when I look at a set of financials, it's like reading a storybook to me. It's fascinating. For those who are not numbers people, you might get that joy out of reading an actual book, but that's how I feel about the numbers that I read. So I hope that after this, you will have some joy. I'll be able to share this joy with you, and you can learn more of your numbers. Number 2, this helps you to identify the symptoms versus the root causes. For example, a decline in gross profit is a symptom of many root causes, such as ineffective pricing, rework, poor purchasing, wastage. Number 3, knowing your numbers will enable you to spot an early warning sign of a potential issue. For example, monitoring how long it takes customers to pay you allows you to quickly respond if that number starts to increase. Number 4, areas of strength and weakness will be highlighted. For example, your balance sheet indicates whether your business value is going up or down. Number 5, understanding your numbers also means you have reliable financial information to base your decisions on. And number 6, finally, knowledge is power. The more you know about your business, the better your business will be. We'll be reviewing each of these key reports to help you understand what you can learn from them. We'll work through an example to show key learnings and things to look out for in your reports. We'll use the same fictitious company, Food Co, for the example. Your trading account. So we start with the trading account. This tracks your sales, variable costs, and gross profit to calculate the return you're achieving before deducting your fixed overhead costs. Your gross profit percentage indicates whether your margins are improving or deteriorating. You can track your results across different divisions or product lines by using multiple trading accounts. For example, if you have regional locations, having a trading account for each location allows you to track how each is performing. Or if you run a venue, some of our clients run venues and there are multiple revenue streams, they might use tracking categories to be able to identify which one of those streams is most profitable, which one they need to maybe increase their prices on because profitability is slipping. Small adjustments to the items in your trading account can have a huge impact on your overall results, which I'll demonstrate now. This is an example of a food manufacturing company's trading account. As you can see, they had sales in green of just over 1 million and cost of sales in orange of 318,000, giving them a gross surplus from trading in purple of just under 700,000. Their direct costs in brown were just over 450,000. So their gross surplus, which is in blue, was 248,749, giving a gross profit percentage in pink of 24%. Okay, I hope no one is falling asleep on me yet. Let's say that this company undertakes coaching with their accountant and implements strategies to increase their customer retention rate, resulting in a 10% increase in sales. They also work with their accountant to review their inventory processes and reduce their cost of sales by 5%. So this decreases to 302,824, a saving of 15,938. They renegotiate their contract with their delivery provider, resulting in a 5% saving in their direct costs. As a result of these changes, their gross surplus has increased by 140,251, and their gross profit percentage has increased from 24% to 35%. Understanding your trading account allows you to identify areas where small improvements can have a big impact on the profitability of your business. Your profit and loss, also known as an income statement, shows all your earnings and costs over the year and tracks the overall performance of your business. It matches your income and expenses for the period with adjustments made for timing differences, for example, sales that have been made but money hasn't been received yet. It's important to remember that profit is not the same as cash. The profit shown in your profit and loss statement includes non-cash expenses, such as depreciation. You must ensure you have sufficient profit to cover cash costs, such as loan principal repayments, asset purchases, and drawings. Your profit and loss statement provides a framework to benchmark your results by using percentages or comparisons between years to compare your business performance to similar businesses. Businesses are generally valued using a multiple of earnings, so your profit and loss statement is a fundamental driver to the value of your business. The higher your earnings, the higher your value. This is an example of a profit and loss statement. Using the same fictitious food manufacturing company, we've taken the gross surplus from the trading account and listed all of the expenses, followed by the owner's remuneration to calculate the net surplus or loss. As you can see, the company is currently trading at a loss in green of over 113,000. Let's say the company undertakes a review of all their expenses with their accountant and identifies potential savings to be made by their insurance and rent to their insurance and rent. They contact an insurance broker and their landlord and negotiate a 5% reduction for both expenses. They've saved 597,000 in pink for their insurance expense and just under 3,000 in blue in rent expenses. Not bad for 2 phone calls. However, you'll notice that accountancy fees in purple have gone up. Remember, in the previous example, the company had engaged their accountant for coaching and other services. Despite the increase, their accountancy fee, the overall net surplus has increased by 138,000 to 24,000 due to the savings made. Your balance sheet, also known as a statement of financial position, provides a snapshot of your business's financial position at a specific point in time. It measures the net worth of your business, which is your assets less your liabilities. It also shows if your business is solvent. If your liabilities are greater than your assets, then the business is insolvent and urgent action is needed to fix this. Sadly, at the moment, there are lots of businesses who are dealing with this, and thank goodness the government has come forward and offered the banks some money so that they can lend businesses once they have a good idea of how to come out of this insolvent trading. They can get a loan, and also they've changed the insolvency laws at the moment. You can compare different periods to determine whether the business's net worth is increasing or decreasing between years and can track the strength of the business. The stronger your balance sheet, the easier it will be for your business to survive a downturn. It also provides a basis to calculate key ratios such as debtor days and inventory days. As you can see, the company is currently insolvent as it has more liabilities than assets. Its working capital is also negative as its current assets in green of 138,475 are less than current liabilities in pink of 162,269. This means the company cannot pay its short-term debts from the limited cash, debtors, and stock it has on hand. Urgent action is required to remedy this. The business needs an injection of funds of at least 305,000 in brown, which may be in the form of share capital or a shareholder loan. Assuming the company can resolve these urgent solvency issues, there are other areas for improvement too. Over the long term, the company could implement strategies to reduce their debtor days and inventory days to increase their cash flow. To calculate your debtor days, divide debtors by sales, then multiply by 365. This tells you how long it takes customers to pay. Currently, this company's debtor days are 26. This means that on average, it takes customers 26 days to pay their bills. If they updated their terms of trade, and requested payment within 7 days and managed to reduce this by 5 days to 21 days, they'd have an additional 13,944 in green available. To calculate inventory days, divide inventories by cost of sales, then multiply by 365. This tells you how long the business holds its inventory before selling it. In other words, it shows how long your cash is tied up in the inventory. This company currently holds inventory for 74 days. If they reviewed and updated their inventory processes and reduced the amounts of inventory they had on hand, they might be able to improve their inventory days by 9 days. This would result in a cash flow boost of 7,860, which is in blue. So while this cash flow gain of nearly 22,000 doesn't fix the solvency issue, it demonstrates how much cash could be saved with some help from their accountant. So we've already been through 3 statements there: the trading account, the profit and loss, and the balance sheet. Now we're going to the statement of changes in equity, which shows what happens to the profits. They could be paid out as dividends or kept in the business as retained earnings. It represents the net worth or value of the company and is a key indicator of the company's financial health. It shows whether a company is solvent. Remember, if the company has more liabilities than assets, it's insolvent, and funds will need to be paid into the company. So, in the case of Foodco, this company has accumulated losses for at least the last 3 years. This means the company has no retained earnings and is currently insolvent. There's no money to pay out as dividends and no money to reinvest into the company to purchase new assets. The directors must take action now to increase the profitability of the company. So I guess I'll just take a moment here to say there are companies that intentionally operate like this, and there can be good cause to operate like this. You know, Xero is a company which is a accounting software, and for years they haven't made a profit because they've intentionally sought investment from debt or equity, and they are working towards profitability. I think they've just turned a profit, but they were spending their money on increasing their market share, developing their software, and now they're reaping the benefits of it. So, you know, this situation is not always a bad one, but it's about being intentional about what your numbers are saying and knowing what you're driving with these results. So now what we'll look at is the shareholder's current account. The shareholder current account records all funds introduced to the business by shareholders or taken out of the business as drawings. It can help you monitor your personal expenditure from the business, and for businesses with more than one shareholder, it maintains a balance of the amount each shareholder has introduced or withdrawn from the business. It shows how much the business owes to each shareholder. If the account is overdrawn, it means the shareholder has taken out more than they've put in and now owes the company money. To put the account back into a positive balance, the shareholder can repay the loan, or the company can increase its profits to pay a shareholder salary, or a dividend can be declared. If the shareholder current account is overdrawn, it's important to get advice from your accountant as soon as possible to discuss the best options for you and your business. The shareholder current account shows that at the start of this period, the company owed its sole shareholder, Mr. Doe, over 29,000, which is in pink, but has taken over 9,000 in green out of the company. Sorry, he has introduced 2,000, which is the amount in blue, into the company during the year, but has taken over 9,000, which is the amount in green, out of the company in drawings and life insurance payments. This means at the end of the period, the company now owes Mr. Doe just under 22,000, which is the amount in brown. The amount owed by the company to Mr. Doe can only be repaid if the company is solvent and has the cash available to make the repayment. Because our example company is insolvent, Mr. Doe will need to introduce more funds into the company so it's not trading while insolvent. To ensure the company will be able to repay the funds introduced, a profit improvement strategy should be implemented so the company becomes profitable. For example, we demonstrated in the trading account and profit and loss statement examples how small changes to processes could result in an improvement of 138,000. It's not sustainable for the shareholders to keep introducing money into the business if it's not profitable. So now we're on to the fixed asset register, also known as a depreciation schedule, records a business's fixed assets, such as vehicles and plant and equipment, and facilitates the spread of the cost of assets over their useful life. It provides a basis for keeping track of a business's assets and can be a useful guide to determine when assets need to be replaced so they can be budgeted for accordingly. It's also useful when selling a business as it records the current value of all fixed assets. So here we have the fixed asset register for Foodco. The first column of the fixed asset register lists the names of all the fixed assets, with the second column listing the cost of the asset at the purchase date. The next column shows the opening value of the asset at the start of the financial year. This is the cost less the closing accumulated depreciation from the previous period. The next two columns show any purchases of net assets or disposals of old assets. A disposal could simply mean that the asset has reached the end of its useful life for depreciation purposes and no longer holds any accounting value. Then we have the depreciation rate and method of depreciation used. This company uses the diminishing value method, which depreciates each asset by a constant percentage each year. I'm hoping that you guys are still with me. Nobody's fallen asleep yet. I know we're right into the depth of accountanese, but it's not going to be like this for much longer. We'll soon be moving on to other things. The next column shows the depreciation for the period, followed by the closing accumulated depreciation. This is the amount the asset has been depreciated by since it was purchased. And finally, the closing value column shows the current value of the asset. This is the value that will be recorded in the balance sheet. So that sums up 6 of the key reports you should be producing and reviewing regularly. Each report tells a different story about your business and aids your decision making in a different way. If you have any questions about any of the reports, send them through now and we'll answer them shortly. In the meantime, we'll move on to understanding the difference between profit and cash. All right, take a deep breath. You'll have done really well. All right, here we go. So it's common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. It's essential that you understand the difference between profit and cash and why a high profit doesn't necessarily result in more cash in your bank account. A profitable business can go out of business because it's starved of cash. A business running at a loss can survive because it has access to funds from investors or financiers. In other words, cash flow is every business's reality. To demonstrate the difference between profit and cash, consider these items. First one, GST affects your cash balance, but not your profit. Loan repayments affect your cash balance, but not your profit. Interest on loans affects both your profit and your cash balance. Asset purchases only affect your cash balance. Asset sales also only affect your cash balance, and depreciation only affects your profit. As you can see, even if your business achieves a healthy profit, there may not be any cash in the bank after paying tax, making loan repayments, and buying new assets. The Business 101 cycle is another useful way to demonstrate the difference between profit and cash. First, the owners need to invest money in the business. So we're up in the left-hand top, owners quadrant of the circle. This money can then be used to purchase the assets needed to run the business. The business may need additional funding to buy all of the assets they need, so they may take a loan to finance the purchases. So we're now in the top right-hand corner of assets. These assets are then, so now we're moving to the bottom right-hand corner. These assets are then used to generate a profit. You can increase your profit by growing your sales or margins, but overhead expenses can drain your profit and result in a loss if they're not managed. Moving into the left-hand bottom corner, the profit then gets turned into cash. Drains on your cash include slow collection of debtors, high inventory days, loan repayments, tax repayments, and payments to suppliers. A business can achieve cash gains by collecting their debtors faster, decreasing their inventory days, negotiating longer payment terms with suppliers, and reducing tax. The owners then take cash out of the business as drawings or personal loan repayments. So we're back up in the right-hand top corner. The remaining cash can then be reinvested into the business to purchase more assets to generate more income. The aim is to go through the cycle as quickly as possible to increase your return on investment. After cash flow, business value is the next most important measure of business success. Part of knowing your numbers is understanding and measuring the drivers of your business value. These drivers might be your monthly recurring revenue, revenue growth, revenue per client, sales or profit. These will be different for every business, but we can work with you to identify the drivers of your business value. To enhance the value of your business, you must first develop and implement a clear plan and document your organization structure and roles within your business. Establishing cloud-based real-time reporting allows you to make better decisions, and reviewing and documenting your systems and processes ensures your business is running as efficiently as possible. Reducing the reliance on the owners of the business helps enhance the value, as it will be easier for new owners to take over when the business is sold. And finally, identifying and managing risks means these can be mitigated before they become an issue. As we've seen throughout the webinar, the profitability, cash flow, and value of your business all affect you personally. If your business isn't profitable and doesn't have much cash available, you won't be able to pay yourself to fund your desired lifestyle. There are a few other things you can do to help protect your assets, which I'll quickly run through now. Set up your business as a company to limit your personal liability. That's number one. Number two, consider who should be a director of your company and which assets are held personally by directors. Number three, ensure that you have security over any money you have lent to others. Number four, consider alternate ownership structures for high-value assets. For example, if your business owns the commercial premises you use, consider moving the ownership of the premises to a separate limited liability company, or even to your self-managed super fund. Review your terms of trade. Number five, review your terms of trade and credit policies to ensure you only provide credit to customers who are likely to pay you. And number six, review your insurances and make sure you have sufficient protection. For example, do you have business interruption insurance, indemnity insurance, and enough cover to ensure the impact on your business of any adverse events is as minimal as possible? In number seven, ensure you undertake financial planning to manage your personal wealth outside of the business. And this can oftentimes be just as important as your business plan for your business, because what you do with the cash that is generated out of your business can oftentimes generate even a larger return than what your business is generating for you personally in your lifestyle. Number eight, and finally, plan for the future. Do you have an up-to-date will, powers of attorney, and a clear plan for transferring your assets to the next generation? This isn't an exhaustive list. They're just some of the ways you can protect both your business assets and your personal assets. We can help you identify specific ways you can protect your assets. How does everything I've talked about today come together as best practice? Well, every business should use the three essential tools: an annual business plan, or in these times, a business recovery plan, an annual forecast, which is your second thing, and your third thing, ongoing reporting and accountability. The reporting ensures the numbers you want to achieve in your plan and forecast are being measured. The accountability process is some form of coaching. Using an independent coach to hold you accountable works. Knowing your numbers is just the beginning, as it allows you to improve them and ultimately achieve your goals for your business. So, where to from here in these challenging times? My aim is to help you to take what you've learned today and implement some positive changes in your business. Now it's time for you to decide what you're going to do. Take a few minutes after the webinar to write down 3 actions or projects that will add value to your business. And I oftentimes find this can be one of the most beneficial moments in the webinar, not to just listen, but to have really, as things were said, they've occurred to you, oh yeah, that's important for my business, and to really take those three things and say, right, this month I'm going to implement those things. I'm going to get X to help me do that, and I'm going to ask them to help me implement it by such and such a date. What problems are you experiencing in your business? Identify these problems and use them as an opportunity to create a project to fix them. Doing nothing right now should not be an option. So now you know what you should be doing as best practice in your business. Here's how we can help you. If you don't currently have a business plan or business recovery plan, we can help you develop one. We can also create an updated cash flow forecast which reflects the ongoing impact of COVID-19. For those who need to be held accountable to complete your actions, we have a range of coaching options depending on the frequency which suits you. We can create your management reports each month, catching up with you to review them so we can discuss potential areas for improvement. And finally, we offer a complimentary 1-hour meeting for both clients and people who aren't clients. We know it may be difficult to commit to spending money right now. All of these services include an assessment as to how you can improve your profitability and cash flow. So there will be a great return on investment from this process over time. For the short term, we have different payment options available, so please don't let cost be a barrier. Get in touch and we can work together to come to an arrangement you can manage. We know that the benefits you'll get from these services will be far greater than our fee. Most importantly, it's about helping you as quickly as possible and ensuring we are working with you to build a stronger, more resilient business. As you will have seen, there's been an offer flash up, and this offer is exclusive to those who have attended this webinar. Since we value your time, we're giving you 20% off, and this is valid for 2 days for all these services that we've mentioned. You can find this offer in the offer tab down below. You will access this discount by clicking on Get Offer and completing the short exit survey. Thank you for your valuable feedback. Just to also note that the information in this educational webinar is general in nature and no substitute for specific tailored advice and support. By working with you one-on-one, we'll be able to identify the most important actions to take that will make the biggest impact on your results. All right. There it is. Thank you very much.
Regarding numbers. And for me, I also like numbers because they say that numbers don't lie. And numbers actually tells you the
That's
truth.
right.
Yeah. So we have to know the
Yes.
truth so that, here sometimes the truth hurts, but it will set you free. And now we've come
Yes,
down to
definitely.
our one of the most important sessions in our webinar. It's the Q&A. And here, we encourage everyone who haven't put in their questions yet to place their questions in the questions tab. But for now, we'll talk about the questions that were submitted earlier before this webinar. Joanna, we have a first question here. What is the difference between the annual accounts and accounts that can be produced throughout the year?
James, that's a good question. Um, I'm not sure what, just to note, there was a bit of a echo there, so I'm sorry if everyone's hearing that echo. But in response to that question, James, it's an interesting one, and a lot of people don't understand it because really this is getting into the detail of accountanese. So what I'll say is that the annual accounts contain year-end adjustments for things like depreciation, tax splitting of interest and principal on loans, prepayments, and other things like that I call the accountanese jargon. The main difference is that the annual accounts are historical, whereas your regular management accounts give you an up-to-date picture of your business.
Very good answer. I hope that answers the question to whoever asked that. And it's a very concise answer. Thank you for that, Joanna. We move on to the next question here. What is the difference between markup and margin? You've spoken earlier about gross margin. Is that the same as the markup that I put on my prices?
Yeah. And this is a confusing one for a lot of people. And the reason is because it's a bit of a yes and a no. I'll give you a bit more detail there. So the markup in dollar terms is the same as the margin in that both are the difference between the cost price and the selling price. But in terms of percentages, this is where it gets different. So the markup and margin are not the same. For example, if you buy stock at $75, so that's your cost, and you sell it at $100, your markup is 33%, which is your $100 sale price divided by $75, your cost price, right? But when you're looking for the margin percentage, it would be 25%, which is the $25 of profit, which you got, and divide that by the sale price of $100. So I hope that answers that question.
Yeah, I think it very clearly answers the question, and numbers actually gets interesting when you talk about profits, right?
Yeah, exactly. And that's what we're all about here, James, at Brew Accounting. It's all about supporting small business to maximize their profits.
Okay, I have another question here. Like, do I need to be good at numbers to understand my financial reports?
Yeah, and the thing about it is that nowadays the technology is so amazing. And there's free software out there. And the thing about it, I always say, is about getting a simple system set up that you're recording your numbers regularly. And then having also a system of reviewing those numbers. And by sitting with somebody for a very short period of time and deciding what are those key numbers I want to be looking at, and looking at those numbers every week, you soon start to see a pattern, you know what I mean? And you know what you're looking at. So I wouldn't definitely
Mhm.
not say you need to be really, really, a mathematician or someone who has excelled in doing their accounts, but just having that simple process in place and knowing what you're looking for can really drive the direction in which your business is going in. And the thing about it is that if you're not looking at it, it's doing what it wants. But if you're looking at it and you know where you want it to go, you ultimately will achieve the outcome you're looking for just by setting that goal and reviewing those numbers regularly. Great
Wow.
question.
Thank you. And I think that's where Brew Accounting can actually help. For those people who are having a hard time understanding their numbers, we have a
Absolutely.
complimentary Brew meeting. It's absolutely free, and will help you understand those numbers so that the more you understand them, the better you will enjoy, and the sooner you
Absolutely.
will get more profits, right?
Yep, that's absolutely right, and it's very much why we run these free webinars monthly, because we understand that these things are not necessarily fun for people, but we love them, so we want to share that love with everybody, and hopefully by learning that information, you're able to then take that into your business and implement it for yourself. But definitely sign up for the complimentary webinar. The complimentary 1 hour session, because you get so much value out of it.
Yeah, and we'll also get to know you better.
Yeah,
So if you think that this helps you, feel free to share this webinar to anyone you think might benefit. So I think that's about it, Joanna. We've come
yeah,
down to those few things, and we've discussed all the questions. If you have any other questions, you can just call us in our contact numbers through our email, or just visit our website at brewaccounting.com.au.
yep,
And for now, I want to thank you, Joanna, for giving us that very informative webinar. And for everyone who attended, thank you for making time. We know your time is very important to us, and we appreciate that. So please complete the brief exit survey as we end this webinar. And remember, you can get the 20% discount that Joanna talked about. So you can put that promo code, that's Brew KYN, in the survey form, and once you complete that survey, you also get your comprehensive guide to your financial report sent straight to your email. So that's completely for free. So
yeah.
thank you, Joanna, and thank you,
Thank you,
everyone.
James, and thank you everyone for attending. We hope we've given you plenty of ideas to ponder and some clear next steps for you and your business. We look forward to catching up with you soon.